If you've paid for eyeglasses, dentures, hearing aids, or a wheelchair ramp in the last year and you didn't write it off on your tax return, the CRA is quietly keeping money that belongs to you. Every single year, thousands of Canadian seniors leave hundreds, sometimes thousands of dollars sitting on the table because nobody told them these expenses even qualify for the medical expense tax credit. And here's the part that really stings. This isn't just about a bigger tax refund. If your net income on line 23600 is too high, it can shrink your GIS check or trigger the OAS clawback. So skipping this isn't just losing a tax credit. It can cost you real money every single month. By the time we're done today, you're going to know exactly which receipts to dig out of that shoebox, which 12-month period to use to squeeze the most value out of your claim, and the 2 CRA line numbers you need to write your claim on. Stick around because point number 4 is the one almost nobody in Canada knows about, and it could be worth more than everything else in this video combined. I'm John AJ, and on this channel we break down real CRA updates and Service Canada rules for Canadian seniors. If you haven't subscribed yet, hit that subscribe button right now so you never miss an official payment update. Now, before we get into the list, I want to tell you about a trick called the flexible 12-month rule. Most seniors think they have to claim medical expenses from January 1st to December 31st, like clockwork. That's wrong, and it's costing people money. The CRA actually lets you choose any 12-month period that ends in the tax year you're filing for. I'll show you exactly how to use that to your advantage later in this video, so keep watching. Let's get into it. Part 1. What exactly is the medical expense tax credit? What is it? The Medical Expense Tax Credit, or METC, is a non-refundable tax credit from the Canada Revenue Agency. In plain English, that means it doesn't hand you a check directly, but it reduces the amount of tax you owe, and in a lot of cases, it lowers your net income, which is the number that determines whether your GIS gets clawed back. You can claim medical expenses for yourself, your spouse, or common law partner, and even dependent children or grandchildren living with you. What is it worth? Here's where people's eyes usually widen. The CRA lets you claim the amount of eligible medical expenses that's above whichever is smaller. 3% of your net income, or a fixed dollar threshold that changes every year, for the 2025 tax year, that threshold sits around $2,834. So let's say your net income is $30,000. 3% of that is $900. That means every dollar you spend on eligible medical expenses above $900 counts toward your credit. For a lot of seniors on a fixed income, that adds up fast. Glasses, dental work, hearing aids, it stacks quickly past that threshold. How do they get it? You don't need to mail in a mountain of paperwork to the CRA every single year. What you need to do is keep every receipt, I mean every single one, in a dedicated envelope or folder. Then, when you file, you total them up and enter the number on line 33099 of your tax return if the expenses are for you, your spouse, or your dependent children under 18. If the expenses are for another dependent, like an adult child or a parent you're supporting, those go on line 33199 instead. We're going to come back to those 2 lines multiple times today, so if you want, pause right now and write 33099 and 33199 on a sticky note. I'm serious, do it. Is this CRA approved? Yes. Now, I know what some of you are thinking right now. John, is this actually legitimate, or is this some loophole that's going to get me a letter from the CRA asking questions? I hear this all the time. This is not a loophole. The Medical Expense Tax Credit has existed for decades. It's built directly into the Income Tax Act. The CRA publishes an entire list of eligible medical expenses on their website, and what we're doing today is walking through the ones seniors forget most often, the ones your accountant might not think to ask about because they assume you'd mention it yourself. Part 2, the expenses seniors forget most often. Point 1, prescription eyeglasses, contact lenses, and hearing aids. What is it? If a licensed professional prescribed it to correct your vision or your hearing, it almost certainly qualifies. That includes your glasses frames, your lenses, contact lenses, and hearing aids, plus the batteries that keep those hearing aids running all year long. What is it worth? Think about the real cost here. A decent pair of prescription glasses in Canada can run anywhere from $300 to $800 once you add lenses and frames together. Hearing aids are even steeper. A single pair can cost $2,000 to $6,000 out of pocket if you're not fully covered by a provincial program. For a retired senior in Ontario living on a fixed income, that's a massive hit to the wallet in 1 year. Claiming it back through the METC can mean hundreds of dollars in real tax savings. How do they get it? Keep the itemized receipt from your optometrist or audiologist, not just the credit card slip, the actual itemized bill showing it was for a prescribed device. Add it to your total for line 33099. And remember, hearing aid batteries count too. So don't toss those little battery packaging receipts in the garbage. Keep them in the folder. Point 2. Dentures, dental implants. and non-cosmetic dental work. What is it? Dental work that restores function, not purely cosmetic whitening, generally qualifies. That includes dentures, dental implants, root canals, extractions, and other non-cosmetic procedures performed by a licensed dentist. What is it worth? Dental implants alone can run $3,000 to $6,000 per tooth in Canada. Even a full set of dentures can cost $1,500 to $3,000. If you're not fully covered under a provincial or private plan, and even the new Canadian Dental Care Plan, or CDCP, doesn't cover 100% of every procedure for every income bracket, the leftover out-of-pocket cost is exactly the kind of expense the METC was built for. How do they get it? Ask your dental office for an itemized statement showing exactly what portion the CDCP or your private insurance covered and what portion you paid yourself. Only the out-of-pocket amount is what you claim. That number goes toward your line 33099 total. Won't this reduce my GIS? No, it can protect it. I want to pause here because I get this question constantly in the comments. John, if I report all these expenses, won't the CRA flag my file or somehow reduce my GIS? Here's the truth. Claiming medical expenses doesn't reduce your GIS. It's the opposite. Medical expenses lower your net income on line 23600, and your GIS payment amount is calculated based on that exact number. Lower net income can mean a higher GIS payment, not a lower one. This is one of the most misunderstood parts of the entire Canadian tax system for seniors, and it's exactly why we're covering it today. Point 3, private health insurance and dental plan premiums. What is it? If you're paying monthly premiums out of your own pocket for a private health plan, a supplemental dental plan, or a travel health insurance policy tied to medical coverage, those premiums are generally eligible medical expenses too. What is it worth? A lot of retired Canadians pay anywhere from $100 to $300 a month for supplemental health coverage once they're off an employer plan. Over a full year, that's $1,200 to $3,600 in premiums alone. Most seniors have no idea this counts toward their medical expense total, and it can be one of the single largest amounts on the whole claim. How do they get it? Your insurance provider sends an annual statement. Sometimes it's called a premium summary or a tax receipt, usually mailed out in January or February, or available for download on their online portal. Add that total in with everything else going to line 33099. Point 4, home modifications for mobility. What is it? This is the one I mentioned at the top of the video, and it's the one most seniors have never even heard applies to them. If you've modified your home to accommodate reduced mobility, grab bars in the bathroom, a wheelchair ramp at the front door, or a walk-in tub, those renovation costs can qualify as medical expenses, as long as they're for a person with a documented mobility impairment and the modifications aren't adding value to the home in a general sense, just accessibility. What is it worth? A walk-in tub installation alone can cost $5,000 to $15,000 depending on the province and the contractor. A wheelchair ramp can run $1,500 to $4,000. These are massive expenses, and if even a portion qualifies under the METC, it can make a serious dent in your tax bill or boost your refund significantly. How do they get it? This one takes a bit more documentation than the others. You'll want a letter from a medical practitioner confirming the mobility impairment, plus itemized invoices from the contractor clearly describing the accessibility-related work. Not general renovation costs like new paint or flooring that isn't related to mobility. Keep every invoice, and if CRA ever asks for a review, that doctor's letter is your proof. Why didn't my accountant tell me this? If you're sitting there thinking, my accountant has done my taxes for 15 years and never once mentioned a wheelchair ramp, you're not alone, and I don't say that to throw accountants under the bus. Most tax preparers are working through dozens of returns in a short window every spring. They ask a general question like, any medical expenses this year? And if you don't specifically mention a home renovation, they have no way of knowing to ask. This is exactly why it's on you to know what qualifies, because nobody is going to dig through your life for these details except you. Point 5, medical travel expenses. What is it? If you had to travel for medical care that wasn't available near your home, the CRA allows you to claim travel expenses. There are 2 distance thresholds that matter here. If you traveled at least 40 kilometers one way for care that wasn't available locally, you can claim public transportation costs or vehicle expenses if you drove yourself. If you traveled at least 80 kilometers one way, you can also claim reasonable accommodation and meal costs on top of the travel. What is it worth? Picture a retired couple in rural British Columbia who has to drive 4 hours to Vancouver for a specialist appointment because there's no cardiologist within a reasonable distance of their small town. Between gas, a hotel room, and meals for an overnight stay, that single trip can easily cost $300 to $600. If they make that trip 3 or 4 times a year for ongoing treatment, that's over $1,500 to $2,000 in travel costs that can be added directly to their medical expense total. How do they get it? Keep gas receipts or track your mileage using the CRA's simplified per kilometer rate for your province. Keep hotel receipts and restaurant receipts if you cross the 80-kilometer threshold. And critically, keep a note of the appointment date and the reason specialized care wasn't available locally, because that's the detail CRA looks for if your file gets reviewed. Part 3, the flexible 12-month rule. Now let's circle back to the trick I promised you at the start, because this is genuinely the part almost nobody knows. What is it? Most Canadians assume medical expenses have to be tracked from January 1st to December 31st of the tax year, matching the calendar year. That is not how the CRA's rule actually works. The CRA allows you to choose any 12-month period as long as it ends sometime within the tax year you're filing for. So if you're filing your 2025 return, you could choose a 12-month window like July 1st, 2024 through June 30th, 2025, or any other 12-month stretch that ends anywhere in 2025. What is it worth? This matters because it lets you strategically group your highest expense months together. Let's say you had major dental work done in October 2024 and hearing aids purchased in March 2025. If you stuck to a strict calendar year, those two expenses would be split across 2 different tax returns, and you might not clear the 3% of income threshold on either one individually. But by choosing a 12-month window that captures both on, say, September 2024 through August 2025, you combine them into a single, much larger claim that clears the threshold easily and maximizes your credit. How do they get it? When you're organizing your receipts, don't just sort them by calendar year. Sort them by date and look for the 12-month window where your total expenses are highest. That's the window you claim. Your tax software or your accountant can help you test different 12-month windows to see which one produces the biggest credit, but you have to know this rule exists to even ask the question. The double benefit nobody explains. Here's the piece that ties this entire video together, and it's worth repeating because it's the single most important financial concept in this whole video. Every dollar of eligible medical expense you claim doesn't just reduce your income tax, it can also lower the number on line 23,600 DRs, your net income. And line 23600 is the exact number Service Canada uses to calculate your guaranteed income supplement, and it's also the number that determines whether you cross the threshold for the OAS recovery tax, which most people just call the OAS clawback. So when you properly claim these medical expenses, you're not just getting a nicer tax refund in April. You could be protecting your monthly GIS check and keeping more of your OAS payment safe from clawback month after month for the rest of the year. Part 4, organizing your claim, step by step. Let's make this practical. Here's exactly what to do, starting today. Step 1, get a dedicated folder or envelope, physical or digital, whatever works for you, and label it medical expenses. Every single receipt goes in there the moment you get it. Don't wait until tax season to hunt through your purse or your kitchen drawer. Step 2, for each receipt, write the date and a 1-line description if it's not obvious. Hearing aid batteries, dental implant, left molar, wheelchair ramp installation. This saves you enormous time in February and March. Step 3, once a year, sit down and test different 12-month windows against your pile of receipts to find the highest value stretch using the flexible 12-month rule we just covered. Step 4, total your expenses and enter them on line 33099 if they're for you, your spouse, or a dependent child under 18. Use line 33199 for other dependents like an adult child or a parent. Step 5, keep every original receipt for at least 6 years. The CRA can request a review of your claim, and if you can't produce the receipt, they can deny the credit. 6 years, no exceptions, keep them. Real scenario, retired couple in BC. Let me walk you through one real-world scenario so this all clicks together. Picture a retired couple in British Columbia, both in their early 70s, living on OAS, GIS, and a small CPP payment. Over the course of 1 year, the husband needed new dentures. costing $2,400 out of pocket after insurance. The wife needed prescription glasses and hearing aid batteries, totaling around $650. They also drove 95 kilometers one way to see a specialist in a larger city twice that year, spending roughly $400 on gas and one overnight hotel stay. Added together, their eligible medical expenses come to just over $3,450. After subtracting the 3% of income threshold, they end up with a meaningful credit that reduces their tax owing. And because it also lowers their net income on line 23600, it helps protect their GIS payment from being reduced the following payment period. That's real money protected, simply because they kept their receipts organized and knew where to claim them. Start your folder today. So here's your one action step for today. Before you close this video, go find an envelope or open a new folder on your computer and label it Medical Expenses. Then go through your last 12 months of purchases, glasses, dental work, insurance premiums, any mobility equipment, any travel for medical care, and start pulling those receipts together. Test a few different 12-month windows once you've got them gathered, and when tax season comes, you'll walk in prepared instead of scrambling. If this video helped you understand something you didn't know before, do me a favor and share it with another Canadian senior in your life, a neighbor, a sibling, a friend from your community group. A lot of people are missing out on this money simply because nobody explained it to them in plain language. Drop a comment below and let me know what province you're in, and if you've got a medical expense you're not sure qualifies, ask me directly in the comments and I'll do my best to point you in the right direction. And if you haven't already, hit that subscribe button because Service Canada and the CRA update these rules more often than most people realize, and I break down every single change right here so you never miss a payment or a deduction you're entitled to. I'm John A.J. I'll see you in the next one.